The Red Sea has always been one of the world's most important maritime corridors, connecting Europe, Asia, and Africa through the Suez Canal. Around 12% of global trade, 30% of global container traffic, and 7% of global energy supplies normally pass through this route, making it one of the world's most critical economic choke points. Why the Red Sea matters: it provides the shortest sea route between Asia and Europe, reducing shipping times by approximately 9 days, compared to sailing around the Cape of Good Hope. This saves billions of dollars annually in fuel, shipping costs, and inventory expenses, while ensuring smooth global supply chains. A new strategic lifeline after the Strait of Hormuz crisis. The 2026 Strait of Hormuz crisis dramatically increased the Red Sea's importance. With the Persian Gulf partially blocked, Gulf exporters, especially Saudi Arabia, were forced to redirect oil exports across the country via the 200-kilometre East-West Petroline, transporting crude from eastern oil fields to the Red Sea port of Yanbu. During the peak of the disruption, Saudi Arabia diverted approximately 5 million barrels of oil per day through the Red Sea, making it the world's primary alternative export route for Middle Eastern energy. The emergence of a dual choke point crisis. However, this alternative route soon came under threat. As Saudi exports shifted westward, Iran-backed Houthi forces in Yemen expanded attacks on shipping near the Bab al-Mandeb Strait, the southern entrance to the Red Sea. The result was a dual choke point crisis. North, Strait of Hormuz restrictions disrupted Persian Gulf exports. South, Bab al-Mandeb attacks threatened vessels entering and leaving the Red Sea. This created one of the most severe risks to global energy security in decades. Energy markets reacted immediately. Brent crude rose above $100 per barrel. WTI crude climbed above $90 per barrel. Oil prices gained more than 30% during July as traders priced in supply disruptions. Analysts estimate that every additional month of continued shipping disruptions could add another $7 to $8 per barrel, while a wider Red Sea blockade could push prices up by another $20 per barrel. Although Saudi Arabia's East-West Petroline provides an important alternative, it has limitations of maximum capacity, 7 million barrels per day. This is less than half of the normal oil volumes that usually transit the Strait of Hormuz. Even after reaching Yanbu, oil shipments must still navigate the Red Sea before reaching global markets. In other words, the pipeline reduces but cannot eliminate the supply bottleneck. Beyond oil prices, maritime transport has become significantly more expensive. War risk insurance premiums in the southern Red Sea increased from approximately 0.3% to over 1% of a vessel's value within days, with ships sailing close to Yemen facing premiums as high as 3%. These higher insurance costs are being passed on throughout global supply chains, contributing to higher transportation costs and inflation. The Red Sea has evolved from an important trade corridor into the world's most critical energy lifeline. Any further disruption could lead to higher global oil prices, rising inflation, and greater market volatility. As geopolitical tensions persist, the Red Sea is likely to remain one of the most closely watched regions for investors, policymakers, and global businesses. The world's energy system now depends not only on keeping the Strait of Hormuz open, but also on maintaining safe passage through the Red Sea. If either route faces prolonged disruption, the effects will ripple across global trade, inflation, and financial markets.